Hey everyone, happy Friday, November 22, 2024. Phil Hodgen here, and welcome to our monthly, well, almost monthly, Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, noon Pacific time. We're going to skip December because there's Christmas in there. And you can listen in online right now, live. You know, this is me live in person, or you can watch the recorded show later on YouTube. We post it to our channel. This month is the first of four episode series that I'm doing on foreign trusts. So this month is the what kind of trust is it? So kind of an overview. So how you can spot the trust when a client comes into your office and then decide what to do with it. So here's the series that we're going to be doing. First, now, what kind of trust is it? And I'm going to talk a little bit about it's a trust and then some other aspects of it, the tax consequences of it. Next month, January, we'll deal with foreign grantor trusts, how it's taxed, paperwork requirement, when you might want to use it. February will be foreign non-grantor trusts, same thing, tax rules, paperwork, and when you think you want to use it or not. And finally, March, going to do a whole hour just on accumulation distributions, so you can follow the bouncing ball all the way from a trust's financial statements and the report that the trustee gives you, all the way through to a beneficiary's Form 1040. Table of contents, here we go. What kind of trust is it? Is it foreign or domestic? Is it a complex trust or simple trust, grantor trust, non-grantor trust? Then I'm going to spend a little bit of time talking about foreign retirement plans, because as a rule, these are trusts, and God help us, they spawn Form 3520 or Form 3520 Cap A potential filing requirements, and so you have to watch out for them. So let's start with what is a trust. So the first thing to know is that you're not going to get a clear answer. And I'm talking now mostly for those of you who are accountants and enrolled agents who are preparing tax returns, not lawyers or trust nerds. The Internal Revenue Code, by and large, well, no, 100%, does not define what property rights exist. That's left to state law or local law or the law of another country. Once those rights have been defined, then the Internal Revenue Code kicks into gear and tells you how to treat it for tax purposes. So specifically here, the government this is just a quote out of Suzanne Pierre versus Commissioner, quoting a Supreme Court case, just to prove the point. Don't expect a definition of what is a trust anywhere in the Internal Revenue Code or in the regs. It's a matter of local law and interpretation. So here is the consensus definition. Trust me, the law part's not going to go very long, so don't worry about it. And there's no quiz at the end of the hour. This book called Restatement, there's this organization called the American Law Institute, and it's full of law professors, and they write these big treatises that sort of say the consensus definition on a whole bunch of different topics is this. So here's the consensus definition of a trust, right? They say three elements, which is really four. A trustee who holds the trust property and is subject to duties that are higher, for the benefit of the beneficiaries. And you'll see this echoed in the next slide to show you. So trustee, second one, you got beneficiaries, and third, you got trust property. So those are the three basic elements that you're going to be looking for. And one person can wear multiple hats, but they should be wearing three different hats with three different labels on them. And if you look at the regulations and the definition of what is a trust, you can see the echoes of this definition right there in the regs. Right? And I've got the little pointers to the magic words. And the one that I want to draw your attention to specifically is the special trustee's duty on the last line of that little quote that I've done. So, and this has to do with the duties of a trustee to beneficiaries. And for reasons of arcane, ancient, medieval English common law, a trustee has a higher level of duty to the beneficiaries than you would expect in just a contract between me and Wells Fargo Bank, right? They don't owe me a higher level of duty, whereas if I am a trustee on a trust and there are beneficiaries, I owe them a higher level of care, and I'm personally on the hook for screwing things up because the beneficiaries are entitled to that right because ancient English common law says so. So that's all there is to it. So really, when the restatement says three pieces, I would say look for four. And so a trustee, a beneficiary, property. So when we come to foreign retirement plans as trusts, you're looking for a funded plan, not an unfunded plan. And then the special duties, which is, going back to, well, I'll show you on the next slide. Let's talk about me versus my bank account. And why isn't my bank account a trust? Because I have given a bunch of money to Chase Bank and said, please hold this safely for me and for my benefit and give me a piddly amount of interest on it. Well, the difference is, number one, the trustee is the person who has nominal title to it, but the trustee does not have beneficial ownership of trust assets, meaning they don't get the economic interest out of value out of these trust assets, as compared to me and Chase Bank, where I am the legal owner of the account and I'm the beneficial owner of the money that's in the account. And another way to look at it is if you think about the banking relationship between me and Chase Bank, what shows up on Chase Bank's balance sheet? Well, they've got a giant liability, not so giant liability to me for the amount of money I have on deposit with them. And you look at my balance sheet, what do I have? I have an asset equal to the money that is over there. And I haven't really sat down to think about sort of untying that in the context of comparing balance sheets between trusts and beneficiaries, but it might be useful to you to say that if you can follow a liability straight through to the person holding the money, it's probably a custodial arrangement or an agent relationship, something like that. And the final thing is, Chase Bank does not owe me special duties that are due to me as a beneficiary just because I have a checking account there. Now, we've got these things in the United States where you can create a revocable trust, and these are super, super popular in California because the probate courts in California might be hideously expensive to operate, but on the other hand, they're extremely slow to close a case. So by and large, if you have half a brain, you're going to do your estate planning with a simple revocable trust. And so I am the creator of the trust, the settlor. I am the trustee of the trust, and I am the beneficiary, and I have the power to revoke and amend and all that sort of stuff. Why is this a trust? Because do I owe a duty to myself as beneficiary because I'm wearing the hat of a trustee and I'm the beneficiary simultaneously? Well, US courts have decided yes, for reasons that they created by fiction and basically saying, well, pretend that there was a third party involved. Like you're the trustee, but there's also a third party beneficiary because there will be someday when you fall over dead, buddy. Or pretend that you are not the trustee, there's a third party trustee, and you are the beneficiary. In that relationship, there would be some sort of fiduciary duty, the trustee to the beneficiary. And therefore, one of these one person fits all, wears all the hats kind of trusts. It's a trust. Outside the United States, this never happens. Ever. And it's incomprehensible. It's a non-event as far as legal systems outside the United States for every place I've ever dealt with. You're going to have at least an independent trustee. So we're just atypical in the world in terms of being able to do these one-person trusts. Let's talk about trusts versus business entities, and specifically trusts that look like business entities. So the regs have a whole blob in them about trusts that are business trusts, and they look like trusts, but they're really business operations. And you can see the phrase that I've highlighted there, a device to carry on a profit-making business. Um, that's what a business looks like to the Internal Revenue Service, as compared to a trust, which is an arrangement to protect and conserve property for the benefit of the beneficiaries. So that's what they do. Now, there are some kind of entities in the United States and elsewhere in the world that are trust-like if you look at them and the sun's shining in the right direction, but they're really there to operate a business. And then there are other situations where you've got what looks absolutely like an ordinary trust, but people are wildly misusing it and running a business through it. So it's not like the trust owns the shares of a corporation and the corporation is doing business. No, the trust is just doing business. And don't get too caught up in this. I think I've only seen one of these in the course of my career. Don't try to get too clever. But where people try to get clever is they say, well, I got this giant cleanup problem for this person with a foreign trust, and I've got 3520 penalties, which are through the roof. 5471 penalties are less bad, and I might get reasonable cause. So I'm going to pretend this foreign trust is a business trust and therefore file 5471s for it instead of treating it as a trust for the U.S. beneficiaries' purposes. Don't do that sort of stuff unless you're really clear. You're taking the locomotive off the train tracks and putting it on a dirt road and expecting it to perform well. It's not going to be easy. So don't get clever. Anyway, here's the clue that you can kind of look at if you want to play that game. And you look for who shares in the responsibility of operating this operating business, right? Shareholders have a vote. Board of directors has a vote. So shareholders would be the equivalent of the beneficiaries. Board of directors would be the equivalent of trustees. So if you can see somehow that the parties all have direct functional power over the operation of what's ever going on inside of this entity, and you think you want to shovel snow uphill in hell in the summertime with a fork to make this thing a business entity instead of a trust, God bless you. You can tell I'm a bit dim on the concept, right? Now, exotica, little things. You are rarely going to see these things, but here's a hint on what to do. Throughout the world, there's basically two legal systems in operation. One of which is if the British Empire ever touched that country, it's a common law country, and its legal system sort of traces its roots back to England. The other one is civil law countries, where typically you can see that the legal system is a rule-based system written in statute, and our friend Mr. Napoleon Bonaparte was the sort of progenitor of all of this stuff and really made this stuff start to work. So there are two systems, and the trust is a feature of common law. It is not a feature of civil law. It's an alien being as far as civil law countries are concerned. Nevertheless, they have entities that operate in similar fashion to what we use trusts for in common law countries. And the United States is a common law country, except for the state of Louisiana. And you look and you see its ancient heritage tracing back to France, and it's a civil law state. Civil law places have adopted trust law by statute. Common law countries, and I give you the citation, example recently touched it, Cayman Islands, has adopted civil law foundations as a feature of their system now. And the idea is generally we call these things a foundation. There's, you see two German words, Anstalt and Stiftung. I hope I pronounced them right. But it's conceptually this thing called a foundation. It's kind of like a hybrid between a corporate structure, but with the economic features of a trust, holding these things, assets, whatever they are, operating, and then giving money off to the designated people or charity or whatever. So a foundation outside the United States is not the same thing as we think of in the US, where a foundation is a tax-exempt entity. It might be outside the United States, but it could be functioning as a multi-generation asset holding device for family, for instance. And again, the IRS is wishy-washy on this and says this depends. And it depends on whether this thing is sort of legally configured and in fact operated as an operating business kind of structure or a passive asset holding kind of structure. And a passive asset holding kind of structure is going to be functionally treated as a trust and something that's sort of, it's got an operating business in it and the board of directors is active and all of that stuff. It's going to be treated like a C Corp. And I've given you a citation to your typical wishy-washy IRS it depends memorandum there, and you can read that and get no clue out of it. My recommendation is that if you have foundations and if there's a reason to have some kind of foreign entity long-term for asset holding for U.S. beneficiaries, roll everything out of the foundation, roll it into a trust. The likelihood that you get into a beef with the government on what is a foundation, C Corp or trust is very low, but you can eliminate that for relatively low cost, and why not go to zero risk, and you've got the kind of entity and therefore the kind of tax treatment that you want. Summary, look for a trustee, look for trust property, look for a beneficiary, and look for some indication that this is a higher standard of care owed by the trustee to the beneficiaries than merely contractual rights. Right, let's dive now. We say, hand wavy, we got a trust, and let's dive into what the Internal Revenue Code says. First one is it foreign or domestic? And we have two tests, which I'm sure you've all heard about, the court test and the control test. And a trust is, this is better to show it to you, a trust is a domestic trust if and only if the control test is satisfied and the court test is satisfied. In all other either or instances, it's going to be a foreign trust. So you can see that the classification rules really skew in favor of finding a trust is a foreign trust. And you need to understand how water rolls downhill, because this is the likely outcome you're going to have unless you have the facts well in hand in your favor. So the court test. A court within the United States is able to exercise primary jurisdiction over the administration of the trust. Well, what does that mean? Administration, what does that mean? It means where the work is done. And you read this and it kind of sounds like all the little fiddly aspects, maintaining books and records, who knows? You'll see in the control test, there's a distinction between substantial and trivial kind of activities. Here, there's no such distinction, but you're looking for where is the work actually done. And a lot of times what I will see is I will have a trustee organized in one country, but functionally all the trust officers are sitting in another country. They're sitting in Geneva, they're sitting in the Channel Islands, something like that. You can have a Cayman trust with a Cayman trustee. So just because the trustee is located in a specific place does not necessarily mean that the administration is happening somewhere, that place. So you can start to see where the fuzzy is. Usually, in my experience, I don't have a problem with this because all we're going to do is we're saying in or out of the United States. So whether the administration is happening in the Caymans or the Channel Islands, I don't care. It's outside the United States. So how do you figure out, now you've figured out where you think the trust is really administered from. How do you figure out whether a U.S. court has, quotes, primary jurisdiction? What does that mean? And the answer is this depends on how the courts and the U.S. laws self-define their jurisdiction. And you're going to see a slide when I talk about the control test about what California's rule is. And California's rule looks again to where's the work being done, and that's it's location of the trustee doing the work. Is you're in California, we got you. The important thing to know is number one, It's not the little clause in the trust document that says the governing law for this trust is the laws of the Cayman Islands or the laws of Guernsey or anything like that. The governing law is irrelevant. It's it's a jurisdiction thing. It's can the U.S. courts, do they think, reach out and touch somebody and enforce their judgment? And if you have two courts, United States and somewhere else, that both plausibly have equal reach, and they could reach out and touch someone and enforce any beefs that the beneficiaries have against the trustee, then if the U.S. is one of them, that's sufficient. So, but again, usually I don't have a problem with this because usually the kind of things that we see will be everything is offshore, everything, the assets are offshore, everything, is happening there. And the only thing that's happening here in the United States is beneficiaries here, or maybe there's an asset. The trust holds a house for the benefit of the beneficiaries. And the mere existence of an asset here is not enough to exercise primary jurisdiction over the administration of the trust. It might be enough for a local court here in the United States to exercise jurisdiction over that specific asset, but not the trust administration itself. Control test. One or more U.S. persons have the authority to control all substantial decisions of the trust. So all substantial decisions, that's the key thing. This sounds like a lot of noise, and I'm giving you sort of hand wavy, this is what it means. Don't get too wrapped up in it, because if Vilfredo Pareto, the 80-20 rule, this is the 20% that you're never going to see, or you're going to see once or twice or three times in your career, unless you deliberately go chasing these edge case kind of things as your practice. So don't think you have to remember all this stuff. Just, remember as much as you want. So what is a substantial decision? So here you have it. The substantial decisions that are made by U.S. persons are broken out into the powers that are given to the trustee or any fiduciary that are not ministerial. So what's ministerial? And they call out bookkeeping, collection of rents, and execution of investment decisions. So you're left to your own devices on what to do, but I think you look at, say, if this is an item that controls how money is invested, how it's allocated to principal and income, how it's distributed, those are substantial decisions. If it's just filing paperwork, I mean, we do trust tax returns for foreign trusts, and the fact that we are here in California does not mean that the trust, the substantial decisions, our firm making substantial decisions on an income tax return, no. The trustee is overseas, the trustee signs it. This is outside the United States. So I would think income tax return preparation and the like is also not included in these substantial decisions. There's an important thing here that happens a lot, and I'll give you one that just popped up in my life in the last month. Well, somebody else's life, or to be precise, death. And an elderly woman has a revocable trust here in California. All of her assets are in there, and she dies. The terms of the trust say the successor trustees are one U.S. person and one of her relatives who lives overseas. So now we have two trustees. The default rule in California is that unless you say otherwise, trustees must act unanimously. So now the U.S. trustee does not have power, over all substantial decisions, because there's a foreign one, 50-50 rule. This is the clause that we use to unwind it. So the successor foreign trustee resigned, leaving the U.S. trustee as the sole trustee of this trust, and we're fine. So what this says is, if something happens in the life of this trust where accidentally you toggle over from domestic to foreign, or I guess from foreign to domestic, if you wanted to look at it that way, but you fix it within 12 months, then it's a no harm, no foul. You don't even have to report it. It's just as if it carried on in the correct domestic or foreign classification that you had all along. So keep this in mind, because this does happen where, I want my niece who's overseas to be the successor trustee because she's going to be getting all the money anyway. So keep it simple. And for an estate planner who's not familiar with these kind of tricky little tax rules for cross-border stuff, it would make sense, right? Except it doesn't when all of a sudden you've toggled to foreign trust status, and now compliance and there's a whole bunch of other messes that you really don't want to have. So watch for this. And sometimes there's another tricky. And so this is one that came into my life recently too, and we worked our way through it. So a husband and wife come from a former British colony, therefore common law. Trust rules work almost the same as they do in the US. And they established a trust in their home country, and it has assets in their home country. And they're the trustees of this trust, and everything is cool. They moved to California, get green cards. Now they're US person, right? Both of them. And they're still trustees. And they're running the trust, and they're making all the decisions, even the trivial ones, and they're doing all the paperwork and the filing and everything like that. Well, California Probate Code Section 17,000 says California courts have jurisdiction over trusts administered in California. Well, here they are. And the foreign country only has jurisdiction over the asset that happens to be in that country that the trust still owns. Therefore, the California court has primary jurisdiction over the trust administration, not the asset, but the trust administration. So now we've met the court test. Better yet, now we say, okay, all of the substantial decisions of this trust, who controls it? Well, two US people, husband and wife. Okay, all substantial decisions and trivial decisions too are controlled by US persons. Therefore, the control test is satisfied. So now what do we have? We have something that looks like a foreign trust holding a foreign asset that is in fact a domestic trust. Now, why this is important is because your reflexive response when you see a foreign trust is, oh, I better do Form 3520. And if this is a grantor trust, I better do a Form 3520 Cap A. Not so fast. You can see in my case, you go through the analysis and you come to the conclusion, I have a domestic trust. I don't have a problem with Form 3520, and I don't have a problem with Form 3520 Cap A. So, watch carefully and don't just look at the document, say, oh, that looks funny, it must be a foreign trust, and conclude it's so, because it's not necessarily so. Next, complex trust or simple trust. And this has to do with the trust document and its instructions to the trustee as to distributions from the trust of current income. And it matters because depending on how you calculate this, how you classify it, your US beneficiary might accidentally have a whole income stream of deemed distributions of current income from this trust that they didn't even know about. Or I've seen court cases that said, well, there was this giant litigation between the trustee and the beneficiary, and it wasn't clear whether distributions were required or not. And the court says, too bad, it's a simple trust. You had income no matter what, even though it was the ball was up in the air in litigation. And the judges in those cases say, this is a really dumb outcome, but this is the outcome that the Internal Revenue Code requires. So watching for these things is going to be important. I will tell you, I have only ever seen simple trusts in domestic trusts. I have never seen a simple trust in a complex trust unless I've engineered it specifically to be a simple trust. You are going to see complex trusts all the time. So what is a simple trust? A simple trust is one that is mandatory that all current income be distributed every year from the trust to the beneficiary, the income beneficiary. And in that year, there are no principal distributions as well. So you can only be a simple trust if the trust document says distribute all current income and you don't distribute anything else. A trust is going to be a complex trust in any other circumstances. So if the trustee makes optional distributions of principal, bang, you've converted yourself from simple into complex. If the trust says the trustee has discretion as to distributing or accumulating income, bang, you've got a complex trust. So how do you figure this out? As I said, this is going to be easy peasy for you, I think. You find the clauses in the trust that say, tell you the trustee how to distribute money to the beneficiaries. And typically in the trust documents I see from outside the United States, there are two. One that deals with distributions of income, one that deals with distributions of principal. And just look for the word discretion, and you're going to see it. And if it says discretion, you know you have a complex trust and you operate accordingly. If you don't see that word discretion, then your spidey senses go up and you say, maybe I have a simple trust, one that requires distribution of income every year to the beneficiary, and my beneficiary is a US person, therefore got some income problems going on here. But if you say that discretion is there in the hands of the trustees, I think you will. It's game over. It's a complex trust. Now, so what's the impact of simple trust status? As I said, simple trust status means that whether cash is distributed or not, the current income up to a cap of distributable net income is deemed to have been distributed to the US beneficiary and must be reportable as taxable income in that year. So you can see if the trust beneficiary is in the dark about the existence of this trust or is not getting information from the trustee or a bunch of other things. Too bad, so sad. When you finally come clean, you're going to find a bunch of back years that are wildly out of compliance. So the second thing is you can see that the simple trust requires distribution of all D&I every year, which means that by definition, there's going to be less accumulation inside the trust. And typically it's going to just be the capital gains that have been earned by the trust and have been allocated to principal. But when those capital gains are later distributed out to the US beneficiary, they come out as accumulation distribution. They get taxed at ordinary rates and with that income charge, interest charge under Section 668. So the idea here is you're gonna have current income a lot. You have to be on top of that, but you have less of an accumulation distribution problem later. Impact for a complex trust, you're going to have to be a lot more careful to calculate what the accumulation distribution is going to be in future years, because you don't have this forced distribution every year that a simple trust does. And so the US beneficiary is safe in terms of reporting taxable income in the current year, because only if there's a distribution is there something taxable to be reported and paid tax on. But on the other hand, we've got this whole, it's like the iceberg underneath the water, the accumulation, which is you're going to have to do a lot of work to compute what that is and then compute the tax liability on it. So as I said, I've only ever seen foreign simple trusts if I've made them so for specific reasons. Otherwise, it's always going to be a complex trust. All right, the fun one, grantor trust or non-grantor trust. Okay, backing up. A trust, again, remember, is a separate legal entity. And by default, it's a separate legal entity, and you can see where its tax treatment is defined in Section 641 to 669, which is you pay your own income tax trust, or you can have a distribution deduction equal to the amount that you distributed to the beneficiary, and the beneficiary pays the income tax on the income. And second line of the first bullet point, I made a secret word there. Peter Elner emailed me about it and we joked about it. That's a typo. That's me being an idiot. We didn't catch it in 2 runs of editing. So sorry, it means nothing. So a grantor trust, now let's go down to what a grantor trust is. A grantor trust is still a separate legal entity. but only for income tax purposes, not for any other purpose. And for the income taxation of that foreign grantor trust, we treat the grantor as having received directly all of the items of income that the trust has earned. And those rules are in section 671 to 679. And specifically the rule that says report everything to the grantor is in section 671. And the way it works, it's an either or. Either if you are a grantor trust, that's your rule. If you are not a grantor trust, you go to section 641 through 669. And I think the grantor trust rules say not a grantor trust. They don't use the phrase non-grantor trust. I think they do in the regs, but colloquially we use grantor trust and non-grantor trust. There is no other possibility. And the final thing, the nota bene, grantor trust means only income tax stuff, not estate, not gift tax purposes. And you know this because you can have a defective grantor trust where income reverts back to the grantor, but the assets are outside of the grantor's estate for estate tax purposes. Most of the rules that toggle grantor trust status for income tax purposes will also toggle a retained interest for estate tax purposes, dragging the asset back into the taxable estate of the grantor, but not necessarily. And you can play with it. You can toggle things on and off to decide what you want to have. So when you use the words grantor trust, be sure you're only talking about U.S. income taxation and nothing else. How to get a grantor trust. Okay, with a U.S. person, it's easy. And I'll just have this slide. And for those of you who have done grantor trusts or touched them, it's easy peasy. So section 671 through 679 have a bunch of rules. Most of them say here, if you have these rights held by the grantor, it's a grantor trust. So that's the second bullet point down, section 673 through 677, and also section 679. If you have a trust where a third party holds a certain power, in this case, it's a general power of appointment, then that third party earns all the income from the trust assets. That's section 678. And this works for both foreign and domestic trusts. So it's wide open. There are a lot of possibilities where a U.S. person can be a grantor of a grantor trust. By contrast, there are only two paths to salvation for a non-U.S. person being a grantor of a grantor trust. One of which is called, if you look in the code, it'll say certain revocable trusts. Well, they're not really talking about revocable trusts, they're talking about something else. And it's sort of hidden in my phrase that grantor can unilaterally retrieve assets previously contributed to the trust. And the second one, the heading is certain irrevocable trusts. And I think that's accurate. But the key is, that the grantor or the grantor's spouse can, during the grantor's lifetime, they are the only beneficiaries of this trust. Doesn't mean they have to get distributions, but if distributions are made, the only people that are entitled to beneficial distributions are the grantor and the grantor's spouse. And this again works for both foreign and domestic trusts. So you could have a domestic trust that is a grantor trust or a foreign trust, but we're talking about foreign trust now because that's where the fun is. Step one is always, who is the grantor? And the rule is that a grantor is either the person who created the trust, signed the document that created the trust, or a person who funded the trust with a gift. And there could be multiple people that fund a trust, but let's just assume there's one person for now. And usually it's one person who both signs the document and contributes assets to the trust. Now, the important thing for the grantor trust rules is that the person who funded the trust is the only person we care about, because the flow back of income from a foreign grantor trust or any grantor trust to the grantor is only done by allocating income according to what percentage of assets you contributed to the trust. So you do a pro rata allocation. And so someone who just signs a trust but doesn't contribute anything gets zero allocation of income upstream. So we only care about the people who gave assets to this trust. Now, if you have the first bullet point is U.S. grantor. I'm not going to go over that because you've got a lot of different possibilities there that make a trust a grantor trust. But for the second bullet point, there are only two places that you have to go to see if this trust is a grantor trust. Does this grantor have sufficient beneficial ownership or control over the trust to make it a grantor trust? And there's the citations, and let's go talk about them. Whoops. So, foreign grantor trust with a foreign grantor. As you know, when I said there's a lot of paths to Jesus for a US person, but there's only two for a non-US person, here's the general rule that constricts the path and says, flat out ban, there's no possibility for a non-US grantor to be a grantor of a grantor trust. That's 672F1, except, because the code is always like that, here's the rule, here are all your exceptions, so here are some exceptions to the exceptions. And the first one is, does the grantor have the ability to force the trust to revest assets into his or her own name? And the second one is, as I said, the grantor plus spouse is the sole trust beneficiary until death of the grantor. So the power to revest. The point of the next few minutes is to drill into your head. Do not just reflexively fall over and play dead because you see the word revoke and say, oh, it must be a grantor trust. It might be. The key is revest. And you can see here on the slide 47, the exception that we are relying on from section 672F says the non-grantor U.S. grantor has the power to revest absolutely in the grantor, blah, 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 either all by him herself or herself, or with the consent of a related or subordinate party who is subservient to the grantor. And that basically means a family member or an employee who has no economic interest in the trust. And it's very similar, not identical, but very similar to 676, which makes a revocable trust a grantor trust. Says same words, power to revest in the grantor. It's slightly different, co-pilot if you want to co-pilot in the cockpit, but the same idea, power to revest. The grantor has the ability to do that. So remember that word revest, because that implies assets went out of your pocket and came back to your pocket. And revest is not necessarily the same as revoke, because revoke implies going back to the beginning. So if you say, I revoke this trust, everybody go back to where they came from. Does that mean automatically the assets go back to where they came from? Or does that mean under the local law, no, the trust has been terminated, and now we have to look at the trust rules to say, where do trust assets go when the trust is terminated? And it could be two different things, or there might even be some secret third thing that I can't think about. But the point I want to make is you cannot assume that revoke means assets go back to the source. It could be revoke means trust is terminated and assets go downstream to the beneficiaries who are named in the trust. Generally, if you have words to the effect that the trustee has power to revoke, that typically I've seen courts say that includes the power to amend. If you have the words revoke or amend, or the trust or the settlor has the power to amend, that's going to be good enough, because worst case, on Tuesday, the settlor is going to amend the trust document to say, I get all the assets back if I revoke the trust. And then the following Thursday, the settlor is going to say, I revoke the trust. Hey, presto, you've got the results in a multi-step transaction. So usually revoke and amend is going to be fine, but I want you to focus on the fact that revest is what you're looking for. So here's, I got ahead of myself. Power to revoke can include the power to revest, but not necessarily so. So how do you figure it out? You have to figure out, there are a couple places you might look. There might be in the distribution clauses, how does the trustee decide how to distribute money? You might find a sentence that says the settlor has the ability to instruct the trustee, or the trustee upon settlor's consent, or something like that. So in other words, the settlor right at the front end decides how assets are distributed from the trust. You might find a clause in there that gives the settlor the power to revoke or amend and stuff like that. What you're looking for, and it may be a careful reading, is make sure that the settlor can unilaterally, or with the consent of a related or subordinate person, I've given you the site there, 672C, so you can figure what it means. Make sure that the settlor has that power. And for the most part, you're going to be okay. I can't see the government giving you a big beef on it, but why not get it straight? So places I would look, I would do a word search for amend. I would look for a word search for appoint. Appoint is this sort of esoteric trust and estates thing where a person is given the power to direct the holder of the assets, the trustee, where to send those assets. So if the settlor has a power to appoint, then the settlor has the power to instruct the trustee to send the assets anywhere. And if that power is back to the settlor himself or herself, game over. That's a general power of appointment. And again, revoke, so these are the three words I would do Command F on, or Control F, and see if I could find them. Now, the other important thing I want to bring to your mind is that revest doesn't mean all of the assets, just means the assets you contributed. So this PLR, I've given you the citation, husband and wife each created a trust, each had the power to revest assets in their own names. And the IRS said, hey, presto, you have a grantor trust indeed, and you have two grantors each as to 50% of the trust. So husband could not force the trust to distribute 100% of the assets to himself, and therefore it was not a grantor trust as to husband for the wife's 50% and vice versa. And I see this occasionally where assets will come in from two places, and both of them will have the power to revest assets in themselves because I made it so. Now, what happens when the first one dies? Well, the one who's still alive still has it's a grantor trust as to 50% of that, that portion that the surviving grantor has. But the part for the deceased grantor is now a non-grantor trust. So now you've got this bifurcated monster, 50% non-grantor trust, 50% grantor trust. What I do in those cases is I build in a general power of appointment for the surviving grantor to retrieve all of the assets out of the trust into his or her own name, and then recontribute them to the trust. And now the trust is a grantor trust as to 100% of the assets, because where did the assets come from? From the surviving grantor. So this is what I do to kind of solve it, because you generally want to keep grantor status as long as possible, because as long as it's going along and you have a foreign grantor, there's no taxable income for anybody in the United States. So summary for power to revest. You've got this Venn diagram and the word revoke and the word revest, and they almost overlap, but not entirely. It's going to be fine. Don't worry about it, but be really, really nitpicky in your brain and precise. And remember, I'm looking for revest. Assets come back to me, not just revoke. I blow up the trust. All right, onward. The second way you can have a grantor trust. This is when the grantor or the grantor spouse is the sole beneficiary. So here we are. So the flat ban on having non-US grantors is solved if you have the trust, the exclusive beneficiaries during the lifetime of the grantor or the grantor spouse are grantor or grantor spouse. Now, what happens when the grantor dies? Then it becomes a non-grantor trust, doesn't it? Because grantor's trust, there's no grantor, so there's no income to be attributed upstream to it. And 672 F2 cap A, two little i's in parentheses, says as much. And I've just given you a slide here with an example from the grantor trust rules in the regs, where you can see exactly this, where husband and wife create a trust and one of them dies and what happens. So just read it and weep. And again, if you want to solve this problem, the surviving spouse has a general power of appointment, pulls all of the assets out of the trust into his or her own name, recontributes the assets to the trust or a clone of the trust, which is a brand new trust, doesn't matter. And hey presto, you're done. And here's examples 1 and 2 just show you again from the regulations an example of how this works. And my bullet point down at the bottom talks about how to use this general power of appointment to extend the lifetime of the grantor trust status until the surviving spouse dies. So how do you figure this out? This one's going to be pretty easy. There's going to be a section that lists all the beneficiaries. It might be in the document itself. It might be in an exhibit attached or a schedule attached to the trust document. And there'll be a whole bunch of people, and typically it's just family, right? With future generations. You then look at the clauses somewhere in the heart of the trust document for distribution of income and distribution of principal. And if the distribution rules say the only person who can get money is grantor or grantor plus grantor spouse, you win. If it says anything else, and it won't, trust me, it's going to be if it says that grantor and spouse, then you've got a grantor trust, but it won't say that. And so you'll have a non-grantor trust. Discretion means automatically non-grantor trust status. And why do we know non-grantor trust status? Because section 671 says, go through this rigmarole, figure out if the trust is a grantor trust. If it is, tax accordingly, like as I'm telling you right here in 671. And if not, go over and see subparts A through D, which is the normal trust income taxation rules, and get taxed that way. All right, let's wrap up with a flyby of foreign retirement plans as trusts. Why is this important? It's important because I have a buddy here in Southern California, Kip Dellinger, and he's a CPA, and a large part of his day job is being expert witness in malpractice cases involving accountants. And he was telling me a month or so ago that he has seen a significant decline in the number of malpractice cases involving international failure to comply, and the client sues the accountant. But what he has seen of what is remaining, by far the biggest problem is 3520, 3520A failures. And by far, he says, the reason why there are these failures, therefore malpractice claims, is because the accountant didn't spot the trust. And foreign retirement plans are where you're going to spot an accidental trust and you don't even know. So this is going to be weird. So just trust me, because it's going to be sort of a mishmash of ideas that you have in your head about trusts, and it's going to be a mismatch of all of the head garbage that you and I have about qualified plans and retirement plans and taxation thereof. Like I'm an amateur in all of this ERISA stuff, and just sort of, no, it must be good. I signed a piece of paper saying it's good. So but it's a mishmash of those concepts. And if you want to think about it, the basic difference is you've got the same kind of beast, a trust, but one is funded by gifts from a family member or from a friend or whatever. The other one is funded by contributions from the employer on account of provision of personal services. So the funding is fundamentally different, and that's where we start to deviate from the true path of what is the trust. I think you should operate that if you smell something that looks like a foreign retirement plan, or let's go even broader, any kind of tax advantaged account under the laws of another country, your spidey senses should go up and just say, might be a trust, until you can prove otherwise. Sometimes they look a lot like custodial arrangements. I just parked my money with Chase for a while and then I get it back when I'm 55 or something like that. But even in those contexts, there are trusts. To give you an example, back in the bad old days when the Internal Revenue Service was going on this eternal crusade against Canadian registered retirement savings plans, RRSPs, they're equivalent to our IRAs. They said, oh, these are foreign trusts. Yeah, okay. They look kind of like custodial arrangements. You park some money there until you're retired. They look a lot like IRAs. Why is it a trust? And if you look, the evolution, it took them close to 2 decades to go from, oh my God, everybody who has an RRSP should be filing 3520s and 3528s until they said, never mind. It took about 20 years. Well, during that evolution, there's a whole bunch of notices and requests for comment. And you see these letters from the AICPA again and again saying, we know that the government believes these are foreign trusts, but there's good reason to believe they're otherwise, right? And so the AICPA is kind of calling bullshit on the IRS, but the Irish IRS is saying, no, it's a trust. So follow along. Just assume it's a trust. And, I've given you a couple citations to look at if you want to go, but I think you're safe in terms of protecting yourself from malpractice and at least giving yourself breathing room to figure out what's the compliance requirement here if you assume trust from starting. So here's Revenue Procedure 2020-17, where the government tried to give some relief for foreign retirement plans, but they failed utterly because it only worked for cases in which met certain financial requirements that don't exist in the real world, but they do exist inside the building and inside cubicles at the Internal Revenue Service. So it said, look at this definition. What is a tax-favored foreign retirement trust? And they were defining this phrase, tax-favored foreign retirement trust, to say, this is the kind of thing that doesn't need to file a 3520. So they start off with, it's a foreign trust. Well, they've already assumed it's a foreign trust. So now we go back to this common law stuff that we kind of don't know. But then they go, we don't really care if the other part that I've highlighted, established under the laws of a foreign jurisdiction, which is important. But it's a trust, a plan, a scheme, or other arrangement. So it doesn't really matter what you call it. To a certain degree, it doesn't matter what it looks like. The inference I take is they're trying to skew it towards, we want to treat it as if it's a trust. So this is why I'm saying just, follow gravity, water flows downhill, government thinks foreign retirement plans are trusts. So adding it all up, you've got these bullet points where I think you've got to look for these. And if you say, I got these, I'm going to have a trust. Trustee, trust property means a funded plan, a beneficiary, the employee. Contributions as a function of personal services, not gifts. They're a purpose. You saw in the RevProc, they talk a lot about the purpose of this thing is retirement benefits, not, free money to buy a house or something like that. And there's strong governance by local law because this makes sure the government, the IRS says, oh, well, if the local tax authorities in Canada are regulating this thing, people are probably not going to use it for tax evasion. And there are 3 possible outcomes for these foreign retirement plans, just talking about the income taxation consequences. One is it'll behave a lot like a qualified plan. The next one, it'll behave a lot like a non-qualified plan in the US. And the third one, it'll be a hybrid between a non-qualified plan and a foreign grantor trust. So here's my little handy dandy flow chart because I love flow charts. You start at the top and you say, first things first, is there an income tax treaty that applies to this? Because if you look at a lot of income tax treaties, it says, if it's their version of a qualified plan for their purposes, it'll be a qualified plan for US purposes. And so if the answer is the income tax treaty says this applies to this kind of plan, then you're good to go. And good to go we'll define on, the income taxation in the next section, what good to go means if a treaty says you're covered. The next thing is, what if a treaty doesn't apply? Well, there are two possible outcomes, one of which, and it depends on how much the employee contributions to this plan are. So just like you can make employee contributions to your 401k and the employer makes contributions, the same thing applies here for deciding how your foreign retirement plan, aka a foreign non-grantor trust, is taxed when income comes out, when income is earned inside, and when money comes out to the employee at retirement. One of which is, so if above 50%, then you're going to do a pro rata allocation, and the part that's allocable to the employee's contributions is going to be a foreign grantor trust. The part that's allocable to the employer's contributions is going to be what's called a 402B plan, because Section 402B is the how taxation of non-qualified plans works. And if the employee's contributions are under 50%, the whole thing is just a 402B employee benefits trust. So let's talk about how these three play out, and I'll be done in a couple of minutes so you won't lose too much of your lunchtime. Foreign retirement plans with income tax treaty protection is the same way as a qualified plan here. The contribution is not included in the employee's gross income. Investment earnings grow tax-free inside the plan, and distributions are taxed if and when they come out. Non-qualified employee benefits trust, this is Section 402B. Contributions are deductible by the employer when they're made, but they are included in the employee's gross income as they're made. So this will affect a U.S. person who is a participant in a foreign pension plan, for instance. The contributions by the employer are taxable income to the employee in the year of the contribution. Investment earnings depend on whether you are a highly compensated employee or not. And I've given you the site so you can figure out what that all means. If you are not, if you're just a regular Joe, the investment earnings are not taxed until distribution, and the distribution of contributions plus the investment earnings are taxed according to annuity principles, right? You get $100 in the annuity, and $12 is income, and 78 is going, did I do math right? 88 is going to be return of capital. So the same idea. For highly compensated employees, there's going to be an annual income taxation of these earnings inside the 402B plan, so much like a foreign grantor trust. So this is effectively a mark-to-market every year. Take the high balance and that earnings, that's income every year, which of course means that the employee has basis of 100 cents on the dollar in this plan because it's taxed every year. Foreign grantor trusts couldn't be easier. Contribution is a non-event, distributions non-event. Investment earnings currently taxable to the employee as if received directly, Section 671. Conclusion. So, conclusion is spotting the trust is the hard part. The client will not proactively think to share stuff with you. That's right. Either because they're doing normal trusts or estate planning. I'll give you an example, Australia, I don't know how many times you've seen that. Or everybody knows that retirement plans don't matter until you retire, and that's the only time you have to care. Not so much. So the point is, have a good checklist. Pretend it's like you're playing Go Fish with your 6-year-old, and just ask the questions. And once you've got something, you go, this is interesting, then you can nail down your suspicions, and you can decide, do I have a problem? Do I not? If I have a problem, what paperwork do I file? And there we are. If you aren't on my newsletter, please sign up. Otherwise, we'll see you in January when we talk about foreign grantor trusts. And that will be January 31. So good luck, everyone. Happy Christmas.